You see my screen? All right, great. All right, everybody, welcome, welcome, welcome to Empower Your Business, Practical Strategies Leveraging Business Tools. So before we get started, I'd just like to do a quick introduction to Start Out. Start Out is a US-based nonprofit organization that focuses on supporting LGBTQ entrepreneurs and startup founders. Our mission is to increase the number, diversity, and impact of LGBTQ entrepreneurs, and also to amplify their stories and drive the economic empowerment of the queer community. Startout's Growth Lab is one of the largest supporting LGBTQ entrepreneurs with 56 graduate companies that have raised $756 million in funding and creating over 3,650 new jobs and counting. I just want to acknowledge our current sponsors. We have many sponsors from notable Fortune 500 companies to community banks. We would also like to thank all of our sponsors who are supporting all of our events, including this event tonight. Now, I am Romika Devi. I am a coach and a founder, and also the co-chair for the Growth Stage Board, and I'll be moderating the panel for tonight. I am now going to introduce Roger for his introduction.
Thanks, Romika. Tonight we're going to go through, we've got a bit about the audience in the chat room, talk a bit about me, and then go through some slides on the sausage sizzle that I'm using as an example, and some slides on accounting and other stuff, and then do a review. If we get some time, I'll cover some, at least one tool as well. So if I could have the next slide. It's I've always been obsessed about making businesses better. I've had 10 or 20 businesses over my 40 odd years of business life. My processes are fairly simple, and a lot of you are doing parts of them now. You just may not be doing all of them in the detail that's important. If we could have the next slide, thanks.
I'm working on the screen share. Just one moment, Roger. I'll have it up just in a minute here.
All right. So the takeaways for today, hopefully, how important people are to your business and how you need to care for them. Knowing where you're going, having a good idea of what the objective is in detail, and aligning your resources. But I'll just wait for Romika to get them up, or I'll get myself lost.
All right, is everybody are you able to see the screen?
Yes, you can just put it into screen, the full screen.
Right.
I'm not seeing it. I'm only seeing the forest.
Yeah, should be able to. I'm just putting it in slideshow right now. My laptop is a little slow. I apologize.
That's
so
all right.
everybody
That's
can see the screen?
Yes, we can see the screen. Okay. Just need to see the slide version.
Okay, here we go. All right. So
I'm not.
Is this the correct spot, Roger?
I can't. I'm just seeing your forest view.
Oh, so you cannot see my screen?
No.
I can see your screen over here.
Yeah, Roger, you might just need to change your view, but if you want, because I know you have the slides with you, right now we're at the I'm obsessed with making businesses better slide.
Right. So the next one, I was particularly keen to find out what industries people are in, because that affects the profit and loss, and find out why they've tuned in today, what challenges they've got, or what opportunities. If I now go on to the where are you now, businesses can be either just starting out, existing, surviving, or success, and I'm focusing on those today. And on the right there, if we're on the same screen, just for the challenges of business, of how many hours you work, whether you're paying yourself well, whether you're getting a return on investment, and how many decisions you have to make, and how important trust is to you or to your business at this stage of it. As you grow, trust is key. You need to bring in experts in different fields.
Roger, I just want to check in. I apologize for interrupting. I just want to make sure we're on the same slide. I'm on the slide that we're showing right now it's about you. That's the slide that we have currently on the screen.
Right. So the next one then. Thanks.
The next one. Okay. All right. There we go.
So this one, I've probably just been explaining that a lot of you will be in the existence stage of your business, maybe moving into survival and success. But the more you grow your business, the more you need people, and you've got to get these parameters right of not working too many hours yourself, paying yourself well, getting a return on the investment that you invest into the business, and hopefully bringing down the number of decisions you have to move. If we go on to the next slide, there's two approaches of how you can move forward. You can either do a stage-by-stage approach and say that I'll get the building up and running, the new building up and running, etc., etc. You can go a few years out and come back and say in 3 years' time, I want to be, and then you work back and say, well, where do I need to be in 2 years? Where do I need to be in 1 year, in 3 months, and what's next month looking like? They both basically give you the same answer, and you're looking at, understanding what's going on now. You need to look at the past and learn from it, get to today, plan for tomorrow, and then set about doing it, checking and resetting and changing what you need to change. Using that same slide from earlier, you can set a long-term view of something like 30 years and say, I want to have a presence in every city, in every country, or you can just go 1 to 3 years out and say, I need to increase the wealth of the business each time I measure it, whether that be quarterly or 6 monthly or annually. And so on the right-hand side there, hopefully you can see that the balance sheet, which is the measure of the wealth of the business, is getting bigger each time we progress. If we go to the next slide, as I was saying, I'll concentrate on financial statements. They're critical to success. James Kay asked the other day, what's an indicator of success and what's an indicator of failure in business? Businesses that fail generally haven't understood their financials well enough. They didn't spot the warning signs that were very readable in them, and they usually haven't done any budgeting, so they don't really know where they were trying to get to. They just have a general perception. Hopefully I'll get to some of these lower ones later. If we move on to the next slide, the famous sausage sizzle, I'll use this as an example because it seems like a simple business, but no business is simple. They might, every business is unique and many have common features. The dynamics of the people are so important, even in the sausage sizzle, but in your business, I'm sure it's the same. And there's always money on the ground. There's always inefficiencies and ability to improve. You've just got to find them. So with our sausage sizzle, it's a charity group, Rotary, that you might know. We turn up at a hardware store. They provide the tents and the barbecues and all the equipment. We just buy the sausage and the onions and bread, turn up and cook them and sell them. Customers usually love it. They're more than willing to pay the price and even leave a donation, which is unusual in Australia. If we go on to the next slide, it's what I'm trying to show here is that a year ago, a colleague of mine said to me, businesses either fail quickly down in the left-hand corner, bottom left-hand, or they fail slowly in the right-hand corner. We've got a local football franchise that lasted 13 years and lost 23 million, and they've just closed the other day. Some businesses succeed quickly. They just open and they're already successful. My definition of success is a good return on investment. So if you've got 100,000 invested in the business, you should be earning 20,000, something like that, as profit above a wage to yourself. But most businesses go that curved line, struggle to improve and go backwards sometimes. Often they get the reasons they don't succeed is that they don't understand and use financial statements properly, not getting the power out of them that they should be getting. And the other big little businesses have is the HR stuff, including paying people properly, but it might be communicating where they're going to people, making sure they've got the right skill sets to grow, what potential they've actually got. And a lot of businesses don't see the potential that's there in their staff, so they're not utilising it properly. And dynamics change as people change, so they become hurdles. I've seen an example recently of a fellow that started with one vet clinic, so he was successful almost immediately. He went on to have 5 vet clinics in one of the regional cities here, and then he went on to introduce pet stores as well. So he went through 3 levels of success. So the point is, you might be getting towards what you think is successful, but there could well be a higher business you've got. If you go on to the next slide, thanks. Not knowing much about accounting isn't unusual with people because it takes about 13 years to become fully competent as an accountant. And a lot of that time, the accountants can spend their time doing tax and financial reporting. So preparing financial statements, making sure they're correct, which is critical. And that's an important role. Sometimes they haven't spent a lot of time doing financial analysis. So if you're looking to grow in the top right-hand corner, that graph I've shown before, you can struggle if you're using a tax and financial accountant only, and you've got a poor or limited, down in the bottom left-hand corner, you've got a poor or limited understanding of financials. So what you want is a local accountant that can help you grow your understanding of financial statements, and you can become quite good at analysing your business, where you are and where you need to make changes. If you've got that combination, you're likely to be much more likely to be successful. So if I use the next slide, sorry, Romika, if I use the sausage sizzle to explain the financials over a series of days, so starting, say, in Australia, it's Thursday today. If we had a sausage sizzle on Friday, on Saturday, sorry, go Thursday, Friday, Saturday, and show you what happens. If we go on to the next slide, in day 1 today, we've got a couple of $100 in cash and some ice boxes that you put ice and soft drinks in, or sausages. We've got about 6 of those that are probably worth $100 nowadays. They're pretty old, but they're still functional. We don't owe any money. This is on the left-hand side. So our net worth is maybe $300. If we go into date, when we start buying and preparing for Saturday, the cash shrinks on the right-hand side. We've got a bit of stock. We've bought some overheads like ice and sauces and napkins and that sort of thing. And we've got the ice boxes, so you can see the cash has gone down in size, but our assets have grown significantly, our resources, and that's come from debt from either our members. I'll use my credit card to buy stuff, and suppliers give us credit. Our net worth has grown because we've got more in there. If we go on to the next slide, day 2 on the left-hand side, day 3 is the day we're selling. So we convert all the stock. The sausages cost 50 cents each. The burger about 82 cents to produce a burger or a sausage on bread. We sell them for $3.50. So if we clean out our stock, we convert it into much more valuable cash, a lot more cash than the stock was, and we've still got the ice boxes. So by day 3, the value of our investment is significantly higher. If we go to the next slide, you can see day 1 to day 3. Day 1 on the left, we're worth maybe $300. For day 3, we're probably up around $2,000, which is pretty good success. Next slide, if we can, thanks. The entrepreneur in a sense says, well, why don't we sell the business? And this is how entrepreneurs get 1 and 1 to equal 9. So we say this is repeatable, we're good at what we do, we can sell the business. So that introduces on the right-hand side goodwill into the equation, which is the future ability to make future profits. So we can show to people from our track record that they will make this sort of money from it, and we ask them to pay for that, which is goodwill. So if we go on to the next slide, in 4 days, we've gone from $300 of value on the left-hand side to lots of money, $2,000 or $4,000, depending on how well we can sell it. So that's the idea of what you're trying to do in your business to get that sort of growth. And how you get growth depends on how well you manage the resources you have, the balance sheet, or the different items you have to use, and how well you manage them over time. On the next slide, you want all 7 levers of cash flow in the perfect position, and that's not easy. They get out of position quite easily, and you've got to keep looking at them that they're where you want them. So from your profit and loss, you've got the number of clients you have and the average sale. They produce your sales. That's the summation of your sales is how many customers, what they buy. Then you go down to, if you're in a trading entity, you've got cost of goods sold. Manufacturers, restaurants, these all have to buy the food that they sell. We buy the sausages and onions. You've got to make sure that you're marking it up sufficiently to get a good gross profit out of it. And then you go down to the overheads, which are things like insurances, wages, rent on the building, and you've got to ensure that you're covering those as well and that there's a profit left. The other 3 levers of cash flow are on the balance sheet, on the list of resources, and not everyone has accounts receivable these days with credit card use, but some manufacturers tend to have it. You may have stock on hand, plumbers and electricians, and that will have stock, as well as restaurants, cafes, those types of businesses, and then accounts payable of what you owe to your suppliers. And it's important that you keep all of those under control, all 7 of these levers. If we go to the next slide, I'll go through a series of slides now on the resources, the balance sheet. So these are the 3 on the right-hand side in that top little diagram on the right. Your current assets, you take cash, you turn it into stock, you sell the stock to your customers and they owe you money, and then they pay you the money and you get cash back and you start again. So again, the triggers to watch, the levers to watch is controlling your stock, making sure your customers do actually pay you, or else you can lose a significant amount of money, and making sure you both keep your creditors happy, your accounts payable, keep them on side, keep them supplying, and keep the minimum within their trading terms. Pardon me. If we go to the next slide, I'll just set those same things out on a timeline. So you go from cash, you buy raw materials, in our case, raw onion, raw sausages, loaves of bread. We start cooking the sausages and onion. So we're adding value, but we're using up labor. We're paying for labor. You end up with stock on hand, which would certainly be the cold drinks, but also the cooked sausages and onions. And then we sell them. A lot of our sales are through FPOS machine, and that gets paid pretty quickly. So the cash from start to end is significantly more valuable because of going through those different resources. There's always a trick to see that we actually get paid from our clients, the customers. We find that we're making a lot of mistakes, and actually we think we're not using the FPOS correctly when things get busy. So we lose the sales, which is unfortunate, but such is life. If we go on to the next slide, got those same assets vertically now. So cash is going into stock, is going into work in progress, is going into more valuable stock, and is being sold to customers and being accounts receivable, and then going back to being cash. And you want this thrashing going more and more. If you're just a service business, so you don't have stock, you're selling your own time, and you've got to keep control of that time. So on the right-hand side, you've got cash going into work in progress, going into accounts receivable. There's risks each time it changes form. You can have lost time and write-offs, and you can have disputes about whether they actually got the goods they say they did, and just non-payment. So if we go on to the next slide, what you're trying to do over time is have the exchange from cash, work in progress stock, and accounts receivable happening more and more in your business, so that it's like a washing machine on steroids. It's just changing all the time between one asset to the next. And the more and more, the faster you can make that happen, and with control, the more valuable your business is going to be. If we go on to the next slide, in the profit and loss, the actual working of the business between two balance sheets, the same thing. You want the number of customers on the right-hand side and the average sale. They produce your sales line, less your cost of goods sold, and less your overheads, gives the net profit in orange down the bottom. And you want to maximize that net profit. I've tried to explain that this way with so you take a balance sheet at any time, but it's usually taken at midnight on the 30th of the month or the end of the month, of what your assets actually are, the cash, stock, debtors, etc. And you then set about running your business for the time period you're talking about, and you're trying to maximize your sales in that time. You've got to pay your suppliers, so a percentage of the sales drains off to your suppliers, and out of the gross profit that's left, you've got to pay your wages, your rent, your repairs, various things like that. So expenses of taking away your sales all the time. There's a little trickle that comes down the bottom to the owners. The board of management would decide what share of the profits the owners get to keep them happy, keep them wanting to invest their money in the business. And what's left goes into the balance sheet as net retained earnings, net profit, and builds the balance sheet, makes it bigger. So if we go on to the next slide, I've tried to depict here the growing value of the business as we go through a net resources net worth at the 1st of January. We trade for 6 months, try and get as much profit as possible out of it, and that grows the value of the assets at the 30th of June. And then we plan forward for next year with how we're going to make it work and become more valuable at the 30th of June next year. And that's the budget down the bottom right-hand side. We're budgeting for what our profit and loss will be and what our resources will look like in a year's time. If we go on to the next slide, I haven't indicated much the cash flow, which is the third statement. And these statements all work on separate areas, but they're all interrelated. So you need to control your profit and loss and your balance sheet, but also cash. What most businesses experience with cash is they have a bundle of cash when they start. They then go and spend it on cars and plant and equipment and goodwill maybe, and stock and employing people. And then they go for pretty much the life of the business where the assets of the cash is pretty, they struggle. And then they grow when they sell the business. Hopefully they get a huge amount of cash back, partly because they've sold the goodwill that they grew. Understanding the difference, hopefully this slide will explain it a little bit. I was talking with a lady the other day and used insurance as an example. So in June you pay $3,600 for insurance. That's a hit on your cash, comes out of your cash this month, but really only $300 or 1/12 of that 3,600 relates to June's insurance. The rest goes onto your resources that you've prepaid 11 months of insurance. If you'd done it back in January and paid it, your cash flow in this month would have no effect, but your profit and loss would show 300 for this month's insurance, and your balance sheet would be down to $1,800 for it. So one last slide on this. This is actually quite useful to businesses, I find. It's called a break-even point. It's working out how many sales you have to make of units down the bottom and dollars of sales up the left-hand side. How many units of sales you have to make to cover your overheads and pay for the cost of the goods sold and break even. If we go to the right-hand side, I've depicted them there. So overheads tend not to change in the short term. They can over the long term, a couple of years. But in our sausage, so we've got about $100 each time we do sausage cook of overheads. We've then got the cost of the sausages and meat and the sausages and onion and bread that is constant. So as it's more the cost goes up proportionally. Pardon me. And then on the right hand side we've got total cost, which is overheads plus the cost of goods sold. And up the top we've got the sales. So as our sales go up, so do the total cost, and so do the cost of goods sold. I worked out the other day, it's only about 37 sausages we need to sell to cover the overheads, but that doesn't cover the labour because we've got free labour. We all donate our time. We need to get up to about 570 sold to cover the cost of our labour, and you want to make a profit. So this morning I was thinking it's probably another 30 or 40 sausages, about 600, 620 that we need to be where we pay our wages. If we wanted to pay our wages to ourselves and have a profit that's a return on investment. The most we've sold is 682, and we can probably do well into the 700s. So we can consistently get really good profits from a sausage sizzle, and that equates for business. It's about working out how to do it. So budgets are integral. Budgets give you much more power to control your business. Numbers are so more precise than words, where you say, I'm going to double my sales in the next year. But if your sales are lousy, doubling them doesn't do you much good. So you might have to be quite definitive. I'm going to go from $1,000 a month to $10,000 a month. It's a very measurable figure. That's the idea of budgets and what expenses you're going to incur in that, and what sort of profit will you get as a return to shareholders in the meantime. So if we go on to the next slide, the more you know about financial statements, the more you'll learn. You'll start finding areas where you go, I need to know this better. And that's where the good financial analysis accountant is so important to you, to draw knowledge out of him or her. Businesses are unique, but they all follow similar patterns. They all have financial statements. And hopefully, I probably haven't stressed a few people enough on the way through, but if you're growing, you need people, you need partners, you need suppliers, and you've got to work well with all of them. So it's important that there's a lot of trust and they believe in you. You've got to know where you're going, and you've got to align your resources have the right resources and allocate funds to them and align them properly. So I'm not sure how we're going time-wise.
We're doing pretty well.
If we go,
You still have time.
is it to go to questions, or will I keep going?
I think we can keep going if you want to finish out the slides.
All right, there's a couple more. I think if we go to the next slide, or maybe the next slide, it's post-it notes. The rest, if I do another session, I'm happy to. It'll be using some of those business planning tools that can be quite valuable. They all rely on using post-it notes and getting the brainstorming sessions and then analysing the brainstorming. So there's a trick to tearing a post-it note, tear it left to right rather than up to down. So across, then it sticks on the butcher's paper better. I'll quickly go through the next slide. I'm targeting this in the middle there, the business model canvas. But it's quite good to go through pastoral, politics, economic, social, technical, legal, and environmental things that are affecting your city and your business. Porter's 5 forces of who's powerful, a SWOT, and then do this business model canvas. So with the sausage sizzle, the economics, they're quite cheap. We charge $3.50. Sandwich in a cup would be $10. So it's a cheap way for people to get a meal. They're happy to give us the money because it's going to charity. We've got to make sure we keep our legal things like food safety, food hygiene under control. Our strengths and weaknesses, we're good at what we do. We've done it lots of times. The weaknesses are our processes need a bit of addressing, but these things all exist. If we go on to the next slide and then the next slide again, we'll have this one pre-periodic review 3. This is a firm called Strategize and brought out the business model canvas in about 2005. I used it in a business. I had a share of an engineering firm. We struggled to use this, I must admit, but I'm now really fond of it. And you can get it on the web, and there's probably 30 or 40 versions of it. Some of them are quite artistic. So you could Google it and just pick one that appeals to you. It takes through 9 rectangles of a business, and I use it now when I'm meeting a client to just get to understand their business. It's really quick, and you can, again, using post-it notes, you can look at it daily and change things around and find that a post-it note you put in one rectangle affects another rectangle. So if we go down, the 9 are broken into the first 4 are how you create value. You start with your customers and your customer segments. Then you look at your products and services and work out how your products help your customers, and what channels you're going to use to get to them, such as a storefront, selling on the web, going to their place, what a lot of professionals I would do, go to their office and sit with them and work things out, and how you keep in touch with them, how you keep them happy to be a customer of yours. If we go to the next slide, then on the left-hand side is how you execute that value creation. So you're looking there at who you partner with. So our sausage sizzle, the butcher's important to us. The hardware store is critically important. They determine whether we get another gig there. We've got our products and services as part of how we execute. Look at what resources we need, manpower, good suppliers, the barbecue that's supplied, but we need barbecue, we need ice boxes, we need to coordinate all that, and then what activities happen. So this is, you do this with Post-it notes as well. Just work out what are the things that make your business operate. All businesses go by bringing in stuff, doing something with it, and selling it. So if you had just 3 Post-it notes, that would be it. But you might have 10 or 20 steps in your business to create value. If we go to the next slide, the last 2 part of these 9 steps are to make sure your business is actually viable. So you look at the revenue streams that came out of how you create value, and your cost structure, which came out of how you execute, and you've got to make sure that your revenue exceeds your costs. If we go to the next slide, there's a subset of the business model canvas that they came up with, which was to be more clear on what your customers need and what your goods and services are. This is the one we used really well in the engineering business. We had 3 or 4 products that were outstanding but weren't selling. The mines, we supplied the mines and the mines weren't buying them. We sat down and worked out what the customer needs on the very right-hand side of the circle, what their pains are and what gains they get if they do their job well. And then we repositioned our products as to why they were worth buying, and they became hugely successful for a couple of years, 2 or 3 products, until the opposition brought in changed the game, and we had to move on to other products. So if we go on to the next slide, it's just that value proposition canvas. So it's really about saying what problem does your business solve? What are the jobs your client's trying to do? What are the pain points? What are the gains from doing it well? How do you align them? In the middle there, you've got to get your products meeting what your customer wants to do, not trying to convert your customer into your products, but getting your products to fit the customer. There's a great example of McDonald's with milkshakes. They were selling lots of milkshakes. They decided they wanted to sell more. They asked their customers, what do they want? And they got vanilla, strawberry, chocolate. They did all that, no increase in volume. So the sales price stayed the same, the volume stayed the same. So they were stuck. They went to Strategizer, who interviewed the clients, found out that 50% of milkshakes left the store before 8 a.m. as takeaways. He interviewed the clients and said, what are you buying the milkshakes for? The clients said, we have a boring half-hour drive. A milkshake's a good way to solve the drive, the boredom. So they went back to McDonald's and said, thicken the milk, make the straw thinner, add fruit to the milkshake, and sales went up, volume went up 400%. So that was just from knowing what's the purpose of the milkshake. The purpose was, kill the boredom of the drive. You can hold it in one hand and steer with the other, and it works well. So if we look at reviewing the session, the next slide, sorry, Romika. Again, it's the more you know, the more you know. Your knowledge just keeps growing if you're positive about it. Businesses are unique, but again, you've just got to care for people. It's people that'll make your business a success. Know where you're going and align your resources to get you there. I hope I haven't gone too fast, but that's probably where I'm at now.
Fantastic, Roger. Thank you so much for that.